Okay, so I wanted to do a video on basically like the longer term trend lines and showing how I can make you much more money in the long term than you ever could, going through a broker like you do now. So, um, if you look at this chart right here, this chart is a tracker of the S&P 500, which it basically tracks the entire market. And so this is a monthly chart. You can see right here, this is a monthly time frame. And so if you look down here at the bottom, this is the year 1999. And you can see how wherever I have my pointer, the line lines up with it all the way across the screen, right? All the way straight up and straight across from wherever I'm at, okay? So this is a monthly time frame. And if I zoom in here like this, make sure something real quick. Okay, so say if I were to come here and look at this, right? So I can draw this uptrend line that goes straight, scoot over a little bit. This uptrend line that goes right through here in this general area. And once this breakdowns, which if I extended this out, it would extend to about right here. Once this broke down, this was the 2001, stock market crash. And so, this total falls about 70% or so. 70% fall in the market. It looks like a very small move, but that's because each of these candles, whenever I say this is a monthly time frame, that means that each of these candles are 1 month. So like this right here, this entire candle is the month of October, right? So what do you see right here when this market goes to turnover? Number one, we see that this red line is on top of the green line. As you see, it's starting to push itself over. Okay, it starts going down. What do you see right here? You see that the green bars are going lower, right? You can see the same thing if you scoot over here. So here we are leading up to the 2001, to the 2008 market collapse. You can do this trend line. I'd go right here across. It would capture most of these candles. So the bottom of the candles itself, the line can be across those. It just can't be across the body. Okay. So when the body of the candle gets on this line, we're starting to be in a questionable position. So if I push this over, here, I'll extend this to the right, extend to the right. So what happens here? We see that boom, one candle, and it's starting, it crosses this line. The next candle's there, and this is leading up. So look down here at the bottom of the screen. This is 2008. This is leading up to the 2008 collapse. What do we also see here? You see this red line cross the green line. You see these green bars right here getting lower. You can zoom out a bit. You can be able to see it a little easier. So right like this. So you can see these green lines getting smaller. Red line crosses the green line, and boom, there is a 138% fall in the market. All right, and you see how long it took the market to get up, all the way from 2003 to 2007. It went up that far. However, whenever it fell extremely fast, which is what the market does, right? So how do we know this? How do we know that this bear market was over right here? So do you see how the red lines are now slanting down? When these start slanting down, that's showing that the trend is changing. So if I were to be over here where I didn't know the outcome, Right here is the maximal state at which it was, going down. Start sliding over, and I mean, you can see that this is going down, so it's starting to be a bullish trend, right? We zoom back out, we see the long-term picture. So what's the long-term picture? Long-term picture is that we're way, up here at this point currently. So if I zoom in on this area, what do you see here? This blue line right here that I have, it encompasses all of this uptrend. Every single bit of this uptrend is encompassed by this blue indicator. This yellow indicator, this yellow line I have here is basically this benefit of the doubt trend line. However, this blue line comes off the 2009 lows, okay? So all the way up, it holds every single monthly candle above it, just touching the tail, not the body, until boom, last month. Now look so this is October right here. It's now November. Look where we are in November. So far, we are below this long-term uptrend. Not only are we below it, see how like right here, this tail, boom, touched it, body was above it. Tail touched it, body was above it. Tail touched it, body was above it. Tail touched it, body was above it. What happened here? Tail touched it, we go lower. At one point, this uptrend line was the support area. Now it's acting as resistance. If we cannot get back over this line, there will be a very swift move down in the markets. And, as you saw for the past, how long is it? For the past 10 years, not one time has this line, been crossed. Not one time had it been crossed back here either until this point. And at this point, what happens? It fell, all right? So what else do we see here that we also saw in 2008, 2001? Well, we see this red line crossing the green line. What do you see down here? Remember how those green indicators back there were getting smaller? So what this is divergence. So as the price is going higher, so the price went, from here to there, which is going higher at that point. As the price is going higher, the volume, the breadth in the market is going down, which is a negative divergence, which means, the trend is changing. The trend is changing to bearish. This is an indicator that you look at months in advance and know like this is, going to happen. I'm not saying it's a certainty that we'll have a swift move down, in the coming days or weeks, but it seems highly likely. And so what's the, cost benefit analysis? Like what's your profit to reward ratio? And if you look at it here, wow, we're up here. You've gotten all the profit you're going to get. It has to pull back, and whenever a market pulls back, it basically this thing called volatility, which we can look at later, it spikes. And when volatility spikes, that means the market moves faster and it sells off extremely, extremely fast. Earlier, I didn't do the best job of drawing that full line, but as you can see, boom, it comes down, it's finding support on this line, and the first month it was below it, which is right here. It kind of like just stays here for a couple months before boom, finally falling, consolidate some more and then falls farther. So this correction, like I said earlier, 80%. From the very top is 108%. From bottom to top of this one, it's 130%. And so here we are, way up here. And if you look here, you can see this a lot easier now. So if you look at ever since 1996, when the green lines are going up, it's a very bullish trend, right? Very bullish. Whenever they start going down, the trend is changing. So the market's still going up here at this point, but the green bars down here, we'll just call it that for simplicity's sake, green bars and red bars, they're going down. Okay, so trend changed here, now bear market. Before the market had even rolled over, this down here is red, as you can see. You can look straight up the line and you can see that. And so what did it cross? It crossed this red line here. So look where this red line is currently. Like, we still have a long, like, just to come down and touch the red line, a lot of money is going to be lost. It's starting to look like it's going to happen. Look at this red here. Look at how the green is going down. Look how the green was going down right here before the 2008 collapse. So right here, as you see, it did the same thing. And this is the only time that I have found in the past like 80 years that it went red without being a full correction. However, this drop itself was 20%, which, almost is considered a bear market. But, so it wasn't. And so here we are, though. Long uptrend. Zoom in. Below the blue uptrend line. This is like super significant, like really significant actually. And there are longer term implications because of this. Technology sector so far. So I just typed in the ticker symbol /NQ, which tracks the E-mini futures, which are basically technology stocks such as Facebook, Amazon, Google, all of those. So far on this long-term uptrend line, it is okay, right? 1 second. So far, it's okay. However, what are we starting to see here? We're starting to see it cross over. What are you also seeing down here at these green lines? Going down. So, the same thing with this chart. The only time there was a false indicator was right here. And it wasn't even a false indicator in this instance, But where did the prices end up going back down to? They went back down to my red moving average. Where are they now? They're way up here. So they have to fall all the way back here just to get to the red indicator, which is another 15%. But from there, it certainly seems likely that there will be a more significant correction, possibly on this scale. As you can see, what is that? This yellow line that I have here goes from the 2000 lows, from the 2000 highs, all the way to the 2016 slight pullback, right? So I have a couple of different stocks that I'm going to go through and just look at and show you what I'm thinking about those. I have those on a different screen, so it'll take me to it though. Okay, so this right here is the Dow Jones. If you come here on this long-term uptrend line, look down here, green to red, is pretty indicative of the forward of the future occurrences. What do you see here? Boom, it's negative divergence. Zoom in, let's see. So far, Dow Jones is still clearly on an uptrend. However, we're starting to get signals that it's coming down. Not only is it going to come down here to this red line, it's a good chance there'll be much more downside to come as well there. Let me go here to SOX. I might have to go to a weekly chart. All right. Okay, if you look across this chart, this is the semiconductor index, and as you can see, we are officially at these upturn, so like, here's the high back in 2000. Where are we now? We're right above that high. I'm not sure why this chart looks like this. 1 second. It's kind of, so all of my charts are basically they're set on a logarithmic scale. So when it's set on a logarithmic scale, it basically it doesn't look like these are that big of movements. However, they're huge movements. So from this 2008 pullback in SOX, and SOX is the ticker symbol right here. SOX, it tracks the semiconductors, which is like Intel, Nvidia, stuff like that. So this pullback right here was 200% in the chip sector. This run up here was 648% in about less than 2 years. Yeah, less than 2 years. So since 2008, we have run up 700%. And where was this high right here? This high was right here at this point. And so see how I have this purple line and this yellow line? Well, keep your eye on the purple line whenever I zoom in over here, okay? Purple line, okay, this is the purple line I was speaking of actually, right here. For the first time, we have now broken down below this purple line. Not only that, but if you look here on this chart, I'm sorry, I have like a lot of stuff on here. If you look here on this chart, as the price was going up, there have been negative divergence. So like, see how the price is going up right here, but this indicator down here is going down. That's showing that there's a trend change was likely. And so if you look at the long-term uptrend line here, from 2008 to here, we're not back on this trend line until at least down here, which is another 50% fall in the semiconductor stocks, right? And it's going that way. I have a short position. I've had a short position actually ever since the break of this trend line right here. It broke this trend line, and these are weekly candles at this point. I'm sorry, I didn't say that earlier. So this indicator down here, it's basically you can change the parameters of it right here to make it less sensitive to the weekly time frame, but you can just ignore this parameter for now because the parameters I have it set for were for the monthly chart and not for the weekly chart. But what I'm trying to say here is that say once you got down here at the bottom, or once you define that there was a bottom or a top to this market, you can then get in a leveraged ETF. So a leveraged ETF. Okay, we'll also look, sorry, I'm back on the monthly chart now just to see what this looks like. And as you can see here, the last time it rolled over, what did you see? Red line over the green line here. This is in 2000. Red line over the green line. The market still hadn't fallen yet, but it was over it, pulled back to the red line, kind of stayed here for a bit, and then boom, fell farther. So overall, this correction right here was, 500% correction. So you can trade a leveraged ETF, which means you can buy either an ETF that directly tracks SOX or one that indirectly tracks SOX, which means as SOX goes up, one of the ETFs will go up with it while the other starts to go down. And the leveraged ETFs trade 3 times the speed or 3 times the amount that SOX would. So since SOX moved 533%, to the downside. If you trade the leveraged ETF, it would have basically went up 1,500% because it's a 3x leverage ETF. So if stocks moves 500% times 3, which would be 1,500%. So you could have made 1,500% just in this little time frame, which is, 733 days, so a year and a half or so. But you see here, red line started, red crossed over. Here, so how do we know this was the bottom to the 2008 collapse? And as you can see, the reds start going back down. Trend change is likely. Momentum turned over right here at the same point. It's on an uptrend. So guess what? If you'd have gotten in SOX, in the ETF that directly follows SOX, so basically it moves 3 times faster than SOX as SOX is going up. From here to there, from that low to there. Well, how about this? Let's just say right here, whenever we saw exactly that the lines had crossed and that we're in a bullish uptrend, say you invested right here, that very point. How much money would you have made? So if it went up 500%, right? And so 500% times 3, because you're trading the leverage ETF, means you made 1,500% in, what is that? 10 years. 1,500% is, pretty solid. So it goes up here at this point, and what do we see? Red line over the green line, green going down, and now, first red. And this seems, so back here when you're seeing these red lines, that was mostly just because it was still correcting from this 2008 collapse. The chip sector, basically, it went straight up, but then it pulled back, boom, and then got on the support line, and then has been trading straight up from here. So what really would have happened, if you're trading this actively, well, not even that actively, considering this is a monthly time frame, you buy in here, boom, it goes up, and so as it's going up, you're still in it at this point, still in it at this point, still in it. So you're up 60, so basically 70% times 3, which is, so you're up 210% in a year and a half. And then what do you see? You start to see these green lines go down. You see the red cross, and so you get out of it right up here. You make your money, it pulls back or whatever, and then once you realize the trend is back bullish, and I would say that would probably be right here. Once this red line crosses, once that red line crosses, you jumped in here, up 275% times 3. Not sure what that is, 800 something percent, I guess. So you actually would have made more than 1,000%, in the long run, just by buying in based off these super simple indicators. And like I said, so here, what's the next outcome of the semiconductor market? Well, it's going to pull back. It's going to have to pull back just like it did here. So see how it pulled back to this red line after it peaked. So what it looked like when it peaked, it goes up really fast and then it gets flat at the top, right? So what has it done currently? It's went up pretty fast. So ever since the 2009 lows up here, it goes up, pulls back, goes up, pulls back, boom. And what are we doing now? This is the topping pattern, is what you want to call it. And so basically we had the breakdown right here. This is a huge breakdown on the market. And this is the next target. And so if you buy the inverse ETF right now, and just for it to get down to the main trend line, you make 40 times 3, you make 120%. And I say, this blew up trend line probably will be hit within the next couple months. And you see your first red indicator right here. Hey, it's a downtrend. It's coming down. So yeah. And note that this blue line here is the benefit of the doubt line. This is the best possible scenario. So the best possible, okay, so that was the best possible scenario that I showed you. Here is the most likely scenario, the other blue line, so you know actually 150% you'd make. And then from there, get out at that point because it'll most likely have a bounce up, and whenever it bounces back up, you'd get back short up here at this point, and then for the last leg down, and because basically it's super cyclical like everything else. It's very cyclical, and the trend's going to change. It's going to change very soon here. Let's look at the financial market. My computer is kind of being slow actually, but it's because I have this recording app going as well, and it obviously takes a bit of juice. Well, I'm gonna close some windows real quick. Okay, here we go. So, just see. Yeah, so here we are in a monthly time frame. Basically, the Russell 2000. And as you can see that these red lines, were a great indicator once again of when to get in the market and also when to get out of the market. And what do you see here? Red line over the green. When did you see that also? Red line over the green. You saw it right here. And what did it do? It pulled back to this red trend line at first, consolidated here for about, it's close to a year, probably about 10 months or so. And then, boom, pulled back, right? And same thing happened in 2000. The huge pullback as well, and that's another 60%. Goes up. Here we are. Look at this first red candle. See how these green lines have been going down while the market was going up, and boom, it fell. Now we have red candles, red line over. So let's zoom in here. And this is the long-term uptrend line. As you see, boom, touches this 2008 bottom. And you can also draw another line, I would argue, right here, because basically, so long as you're not into the body of it, but just the tail. So as you can see, it's, tail here, and here we are at this line. So this would be the first line. This would be the benefit of the doubt line, right? Before you say, okay, yeah, the markets have broken down. You zoom in, right on the line, red sign here. Let's look at it on a weekly chart. So I actually shorted this and made a good bit of money on this one whenever it broke this line. So this, I was watching this line. Whenever it broke this line, I shorted here down to this point. And so, yeah, so I made 7 times 3. I'm not sure if I stayed in for the whole move, but I made a good percent. So like you can also trade leverage ETFs for IWM, which means when this moves 3% down or up, you can trade either the direct ETF or the indirect ETF and make 3 times the profit. So, just this move itself is 21%, and this is a weekly time frame now. I changed it to a weekly a second ago. So you make 21% in 1 week right here. But it moved farther down. So if you stayed in it longer, you're up 10 times 3, 30%. So as of now, it's at support. So what am I waiting for here? Well, I'm waiting for, let's create alert. I'm waiting for this line to break. And when this line breaks, it's time to get back in short. However, I'm also open to the fact that the markets continue to go higher. I'm not absolutely saying that they're going to break down immediately. I think there's a chance that we've just formed a topping pattern in which we actually might stay and hover up here at these ranges like we did back here at this point, and eventually, so basically we got to break down farther to get to this gray uptrend line, which would be here, and this would be on this long uptrend line, right? The benefit of the doubt line that I said, and then it'll be like this right here. It'll be back on this gray line, trending before boom, it finally ends up falling. And as we said earlier, that was, it took a little bit less than a year, or it was up there for less than a year. So it's not, I'm not absolutely saying that it's going to completely fall off tomorrow, but I am saying that based on all the technical analysis, a trend change is likely. Okay, and so the profit to reward, risk to reward ratio is no longer favorable for being long the market. It's now favorable for being short the market. And when that changes, when will that change? Well, when did that change here? The red line crossed the green line, it came down here, boom, turned over. That was the time to buy. This is going down. This is time to buy. So see how this is down here? Well, look at this. We're up here now. It has been up here for a long time, but like I said, remember, when the market sells off extremely fast and a lot farther than what it goes up. It's like, see here, it goes up like, it went up like 80% over the course of, we'll go all the way across actually. Well, over the course of, 1943 days, which however many years that is, the market went up 109%, right? Or the IWM ETF went up, which tracks the Russell 2000, went up 100%. But then how long did it take for it to go, drop this far? And we can say from right. I went to this, right? Yeah. So we'll just say from right here to there, which is 172 days. The market dropped by 100%. So pretty much all the gains have been made since 2000, since the 2001 reversal back up, had been completely wiped out in less than 6 months. So that just goes to show you how fast it is once it moves down. And we've been on this long, extremely long uptrend line, and we're here at very critical areas. So that's for the IWM. And I know I'm repeating some of the same things, but I think it's important to repeat the same things and to get the point across that looking at these long-term charts, you can see a much better picture. And so this is interesting. If you look back to 2008, what was the first sector to break down? Real estate, the home builder. So like this ETF right here tracks U.S. real estate and home builders market, okay? And so number one, this is defined by this uptrend line, as you can see here. First red line right here signified a downtrend. If you go directly down, see directly down, boom, red line crossed. Greens are going down. It's red, right? Crossover, and then that market dropped by 300%. So from here to there is 750 days. So yeah, a year and a half or so. And that was a 370% fall in a super fast amount of time. But so what I'm saying here is that what happened? This long-term trend line was broken. It fell down to the red line, and then it was a couple months later, 464 days, so actually a year later, before it ended up falling. So if you look where we are now, which is interesting, all right, so see this blue line right here? This is the long-term uptrend line for this ETF. Boom! It fell below it here. It regained it, but it failed again. And so also what it's showing now is that just like back here in 2008, that once it failed it was in this topping pattern. So it was up here at the top, right? Zoom in over here, boom, it's in this topping pattern. We're on the red line. The next step for here will be the gray. And also something really important to note is as this market has went up, as the prices increased, this PPO indicator down here, which is kind of hard to see, it's been going progressively down this entire time, which shows you that there was not near the breadth in the market that there once was, okay, or in this particular area. So like this shows that this is going to have a very significant pullback soon. So that's the negative divergence I was talking about earlier. Not to mention these indicators here are already red. Like it seems quite ready, in my opinion. And so, but like I said back then, the first indicator of a downtrend was the real estate market, and here we are. And this one has been already beating up this red line already quite a bit. But see how this red line is no longer sloping up. See how it was going up right here. See this up angle? What's it doing now? It's flattening. This is a topping pattern. It's flattening out, flattening out, flattening out. Boom. Okay. All right, so let's move on to let me think. Let me grab a charger. Okay, I'm back. So earlier I showed you QQQ. I'm not sure if I showed you QQQ. Yeah. So basically QQQ is the same thing as the /NQ that I showed you earlier. It's just that you can trade this one, right? So say you had invested, so back to the same thing. Green line's going down in 2008, red here, uptrend line started, right? So say once this uptrend line was defined, you actually invested in QQQ. So since this point in time, QQQ has went up 400%. So 400 times 3 is 1200%. However, the thing is about leveraged ETFs is they actually move. Whenever there's a unidirectional movement, they actually move much faster. They go up by more than 3 times the amount. So I'm about to type in the ticker for the stock that trades 3 times the speed of QQQ, which is, let me think, is it TQQQ or is it SQQQ? Yeah, TQQQ. So look from here. So this is just since 2010. So say you had invested in this tinker that goes up 3 times the speed of QQQ. Say you invested here, and this is what I mean by unidirectional movement, basically far exceed your profit more than 3 times the amount. So from there to this top, do you see the percent in the corner of the screen? You're up 4,941% since 2010. From 2000, so in 8 years, you're up 5,000% basically, if you're in for this whole ride. And so it's like whenever it's time to invest and get this run, I'll be prepared to do that with the money. But also, whenever it's time to get out, there's no sense in losing this amount of money here. Like there was, it was very obvious that it had topped earlier. So I mean, that was a 53% fall so far, and it has lower to go. But so 5,000% in 8 years in another stock. So that just goes to show you what you can do, or how easy it is to just invest in something once the market has shown you it has bottom and it's time to go up. And it's a very safe play, as you see. I mean, this is just straight up, straight the entire time. And that's what happens once the market bottoms. Look at Amazon. Since 2008 is right here. We zoom in. So from 2008, and look where it's holding support every single time with this red line. Boom, 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 boom. Red line, red line, red line. All the way up, and it's gotten quite overextended, right? You've gotten most of the profits out of this bull market. Go up, look how much percent this has went up since 2008. 3,000%. 3,000%. Okay? Just recently, and I was actually, because Sid invested in it at $1,300, which is right here. And I told him, like, whenever it got up here to, like, it was in the summer, so I think it was in August, which was actually on this candle. I said, dude, it's time to get out of Amazon. Like, you need to just take your profit. Because he was up like $10,000 or something. So you need to take your profit. It's like basically whole numbers are like a big deal in the market. So it hit this $2,000 mark, all right, per share. And what happened? Not that month it happened. Everybody thought, oh, it's going to keep going higher. Nope. Boom. Had a huge correction. What is that? 30%. I mean, it still has farther to come down. I do see it come down, hitting 1350 and most likely lower. And you see this red line just crossed here. These green lines are getting lower. So it does seem as though there's going to be a big correction. But say the brokerage had your actual best interest in mind, a stock such as Amazon, if they just bought that and left your money in that one thing, you're up that's more than earlier. You're up how is it more than earlier? I must not have clicked on the very bottom earlier. Okay, say if I click right here, boom. Okay, so you're up 4,000% just for investing in Amazon, right? And what you do is you don't just invest just in one stock. You invest in multiple stocks to make sure that you never know what's going to happen with a given company, but in the long term, you know what's going to happen with the sector in general, right? So if you zoom in here on this, and you see how the yellow lines change once I zoomed at that point, because like right here, it's like, how do you make sense of that? Well, it's pretty hard to, because basically the way you have algorithmic scaling and you have logarithmic scaling. What did I just say? Okay, you have logarithmic scaling and arithmetic scaling. Okay, and so number one, it needs to pull back to here, which would coincide with that 1350 target that I told Sid about up here at 2000. But if you zoom in here and you see how these two yellow lines are about to change, boom, they change because it's based off of percentage and a logarithmic scale rather than other things. So if you go zoom in here, and there's kind of like two uptrend lines that I would say. Oh yeah, I forgot. Well, okay, so there's two uptrend lines for Amazon. You have this one, which is my benefit of the doubt uptrend line, and then there's this one, which is one that actually kind of goes through this week. But see how there's like a gap up through it, and then it found support at this line here. Okay, so now what's happened with that line? If I zoom in here on the daily, look here, boom. It was beautiful. It really was. It got here, this line, it found support for a day, fell straight through it, hit my second line down here. And these lines have been here. Hit this second line, and then bounced back up, and where to get rejected? Right back at this yellow line. And what do you see here? See how this red line's coming down? It exactly hit right there. Look at that. That's a perfect doji signaling a reversal, right? Boom, it goes up, boom, reversed by the moving average and the signal of this doji right here going down, right? And boom, I imagine it's going to come down, hit here. I'm not sure if it may boom bounce to here and then back down, or it may just go straight through it, because like I said, the selling accelerates once you went past key key uptrend lines, and as you see, it's testing this main uptrend line, and from there the next one is here, or all the way down here. So this is it, but regardless, the point was with Amazon, just like the others, if your best interest was in mine by the brokers, it's nothing to make this money, like nothing. So let's go over here to Google, and it's the same story. So since 2008, boom, what is the uptrend line that's captured absolutely everything? This blue line that I have here, it's captured. I mean, I actually went through every single stock in the Nasdaq, every single stock in the S&P 500, every single stock, and I've done these lines and went through and done technical analysis on all of them. It's taken about 2 weeks or so, but looky here, blue line going up. Look at it. I mean, perfectly. Like, look how perfect. Boom. The only time it's almost kind of disobeyed it was right here on this weekly chart, but it snapped back above it, impressively with this huge green candle, right? Boom, hits my blue up trend line, hits it again right there at that tail. See, perfect, perfect. So look at some more perfect ones. Perfect, perfect. And maybe I can move the line up just a hair, and it would have touched maybe more of these, perfectly right at the bottom. But what do you see here? Uh-oh, it's in kind of trouble. What do you see here? Red line crossed over, and the red line crossed over. Look, as you see here, back here before this point. This showed you before this even happened that was going to happen, and it failed this moving average. This red line right here failed moving average on the green line. This is in a very important time. A very important time. And I remember telling Mom the market's in a very precarious situation right now. And this was October, around October 15th that week. It broke down. So Google has now officially broke down, right? And I'm just, at this point, I'm just waiting for it to fall through here, and I have a, an alert set, and obviously Google has a ways to go down. But say you had invested in it back here in 2008, once you realized that there was a trend change, boom. So red line, see how it crossed, red went down. Basically it's bullish again, right? It's bullish pretty much all the way through here. And right here I would have sold because you see this coming, and look what happened a couple days later, and it ends up dropping. So from where that was to here would have been up, 30%. So you saved yourself losing 30%, and then you buy it back here, and then you make more money. But so at this point, what do you see? Red line crossed, just like the red line crossed back here, and as you see, this happens generally months in advance of the final sell-off. But oh yeah, see, look at this first red right here. First red is coming in. So yeah, but if you'd invested here in 2008 when you realized there was an uptrend, say we're going to wait until we know for sure it's bullish. Say you invested right here. At that point, say okay, probably right here. So okay, the market's bullish. Let's buy in, and you stayed with it all this time. You're super bullish, whatever. You made 500% on Google. So not as much as the others, but and so also the important thing about QQQ and the other things I've been showing you is that they don't just focus on one stock, rather they track the entire sector. So basically within QQQ you have Netflix, Google, Amazon, Facebook, Intel, all those different stocks, right? And so you don't have to worry about just one of those companies failing, right? The entire markets, whenever all of those are going up, then you can just invest in that and not have to worry about the possible downside, the possibility that one company has something go wrong with it or something like that. You just reap the rewards of the overall tech sector going up. And so there's your 500% there. Apple. Apple's a good one. So, and it's pretty, yeah, it's nice. See here, boom, red line crossed. That was a sell-off 2008. um, crossed here, and that was a very significant correction, wasn't it? 70%. Red line crossed, down. And okay, and something very important about this chart actually is the fact that ever since this thing has been going up, so all this time while it was going up, what do you see here on these indicators? They've been going down. This is negative divergence, okay? Which means there's going to be a rather large pullback the next time it pulls back. And it seems to be, I mean, as you see here, red line is about to cross. And so far there has been a lot of volume, a lot of green here. I will say that. So on the monthly, it's not absolutely terrible. And I've actually charted this quite a bit. So let's see the price. Say if you'd invested in it after 2008, once you realize, right here at this point, once you realize the trend was bullish again, you had made your 1,500%. So the fact that however much money you made through the brokerage that you put your money in was 10% or maybe 15 or whatever it was per year, that's absurd. Like, I mean, just putting it in one of these stocks, I mean, it's sad. It really is, because I mean, this is, and so this, I mean, this opportunity will obviously show itself again in the future once the markets pull back and once it's time to, once there's a all clear, right? Right now, the risk to reward is just like, look at this is nearly vertical. This is parabolic. Like this was on a upslope, but now it's just like it was like straight up right here. The same way with Amazon. Let's go to weekly. The interesting thing about this chart is that this blue uptrend line encompasses all of the uptrend lines since 2008. Okay, this one right here goes up, and look here from this top, this top, this top. See how this goes in with all those tops? Boom! It came here, and I'm completely open to the possibility that, or I was completely open for the possibility that the markets could continue higher. And if you look at this, I mean, this would have been like perfect. Like, so you have this long-term blue up trend line here. You have this yellow line coming across, and look, perfect. Where it would have, if it would have bounced right here at that point, that would have been a perfect bounce. So this is a daily time frame, and this is today. So like, there's always that chance it could bounce off this tomorrow, and the market could eventually end up going back higher. But I mean, I believe it's failed this line, and if it fails here, I'm trying to create an alert for. Create an alert in both directions, because anything's possible. But once it fails here, there's significantly more downside to come. So yeah, but there's Apple. Okay, and this right here is VIX. So VIX is the volatility tracker of the market. Okay, so if you come back over here to 2008, what do you see leading up to 2008? So from the market collapse to here, you see these extremely low values, right? If you look at the long-term trend line. So this right here is about average. Right here in this range is 20 range. You kind of see it here. But what happens whenever you start getting down here low? You get this huge spike, because basically that means that the sentiment is extremely bullish and no one thinks anything bad can happen in the market, right? And then next thing you know, VIX shoots up 400%. What'd you get down here? Extremely this sentiment was extremely bullish, and it was, people just thought, oh yeah, nothing bad is going to happen, right? And this was until recently. It'd been all the way down here, broke out there, came back, found support here. Now it's shot up, so it's went up 170% in 68 days. And now most likely it'll probably start finding support right here at this level, just as it did back all the way back here in 2008. It goes up, boom, starts finding support this higher level. This is that same yellow line I just showed you a second ago, right? Starts finding support this higher level before, boom, the final move happens. that 400% spike. So keep in mind this yellow line. What happened? It was down here. The sentiment was low. Boom, gets up above it, starts bouncing here, bounced here for, basically about a year before the big move. Here we go up here. That same yellow line is right here. So, sentiment thinks everything is going to be perfect as we did here. And like, look at this perfect. Like, see how this is basically this descending wedge, ascending wedge. You see it, and then boom, breaks out above it. And now that we're here, we're going to start going back and forth between these two areas like this. Eventually, boom, the big spike's going to happen, probably months from now. And that, so that just goes to show that I'm not just looking at one or two indicators. These are multiple indicators. You see, here's 2000 and here's now, current day. And then if you look right here, boom, here was back here, right before the 2008. And so see how we're back at that same level. And now this time we're holding it like back here at this point. It was just like a little short spike up. It's not like it was now. There's a inherent technical difference that you can see between the two. And the same thing can be noted right here as well. Boom. So it's down here, very low sentiment, gaps up, starts moving here at this level, finds support there. There's more volatility in the market before, boom, your final jolt up. I'll scoot over. And yeah, that was 2001 at that point. So it went up 180% there. Yeah. So that's volatility for you. And another thing really important to note is that almost all the other markets are already in a bear market. This is China. It's had a significant drop. This is just their large caps. It's already had a 100% drop off its highs, and this is so it's not. China isn't technically in a bear market yet. Well, it is technically in some areas, but this is the uptrend trend line holding it up, and as soon as this area goes, there'll be significantly lower prices to come in China's market, and that does affect us, and that will affect our market as well. And you can't just have an extremely strong U.S. dollar in comparison to the rest of the world. Like, it's just it won't work, because people won't be able to buy our stuff because it'll take so much of their money in order to buy such a thing, right? Where's it at? Yeah, and this is very interesting here. So, and this kind of gets more complicated, but there's these things called futures. And so as you see right up here, there's E-mini, S&P, so which is like the SPY futures. And what this is looking at, so see how it says December 2018 right here? Basically, you're able to trade futures, which are something that happens in the future based off the current prediction, your current prediction, and which way you think the market is going to go. And so most of these predictions aren't people making these predictions, they're algorithms. And as you can see with this algorithm on this long-term uptrend line that has encompassed all of these, what has it finally done? It's broken down. The red line's up here above it is broken down, right? And so that's what they think is coming in the future, not just random people, but the algorithms that make this stock market happen, right? And the entire world market for that matter. Let's just look at this real quick. USD. Yeah, so this tracks the US dollar in comparison to the euro. Okay, so basically we're just doing simple technical analysis right here, right? What do you see back here in the year 1999? Boom, the dollar gets very strong in comparison to the euro, which means it also gets very strong in comparison to it gets very weak in comparison to the rest of the world. and then the dollar starts leading significantly, right? The dollar starts really leading, and then this is what eventually led to the 2001 financial crisis, right? And look over here. I mean, it looks almost identical. See how it had consolidated? You saw this jump up. Look here, consolidated, jump up, and now what happens? We're going down. So you see this same pattern going on right here as well. Yeah, same thing. But yeah, so there that is as well. And you see, okay, so this right here actually tracks the semiconductors that are involved with the SPY. So just basically, it's another thing that tracks the semiconductor index. And as you can see, this blue up trend line's the main up trend line, and we're right here flirting on it. And it appears as though it's going to break, and I expect it to break. As you see, red line cross, first big red here. And so yeah, it's going to break. It's going to fall here at the very minimum, maybe have a little bit of a bounce and then back down. And yeah, so that's the cycle there. And so here's something, TMV, right? So TMV is the bear treasury ETF. And so as the market is going higher, bonds go up with it too, right? Here now, since we're starting to see a change, we're starting to see all these big funds take all their money out of the FANG stocks, which are Apple, Google, Amazon, all of those, and they're starting to go back and invest them in treasuries. And so number one, this is the first breakout. This is a long-term uptrend line. Boom, it broke out here. It back tested, well, kind of back tested, and there are going to be higher prices to come in this. And so I mean, as you can see, it's just been on this huge downtrend line for all this time, and the sentiment is finally starting to change. I mean, this is a big change right here that this happened. Very big change. Yeah, I mean, so number one, this is broke out in the direction that would suggest that the market is going to be going down in the coming months, and this is the big financial institutions making sure they don't lose all of their money by going into ETFs such as this. And there's a lot of different things that play a role, and I'm not going to go into all the details, but there are various factors and various ways in which the rich keep getting richer and the other people suffer, right? Okay, this will be the last one. We can just look at this real quick. And so well, we can look at I will look at this and one more. So here's the 2008 low. Oh, okay, I already had trend lines. I thought I did. Yeah, so more downside to come here. This tracks the technology sector, and as you see, look at these. We had this negative divergence. While the prices were going higher, this PPO was going lower, and then that facilitated the breakdown, and there's more downside to come, at least to there. You can trade leverage ETFs with these, so that's 30% by the time it hits my final target. So let's go to XLF. XLF tracks the financial market. Zoom in here, and from this blue line, look at this blue line, encompasses all of it. Here's my yellow line, benefit of the doubt trend line. But as you see, it is in a very precarious situation, and it just saved it. But look what's happening here. See how this red line, for the most part, okay, well, also before I start to zoom back out, look at this divergence going straight down while the market was going higher. This is negative divergence. That right there was your time to get short. Once you saw this cross over, that was the time to get short. And if you would have gotten short there, the leverage ETF, you'd be up 20 times 3, 60% in about 2 months. So what am I looking at? Oh yeah, the longer term time frame. Yeah, it certainly seems quite bearish. This is very precarious, very precarious situation. Oh yeah, this is what I was looking at. So see how at this point it started, this line had been going up for all this time, and then it started to flatten out. Same thing happened here, except more significantly. And most importantly is that now that it's crossed over, it was kind of flirting with it here back and forth, but now it is officially in this downtrend line. It rejected there. See how it's just the tail? Rejected. More downside to come, right? Once it breaks this blue line, that is the main uptrend line, right? It's the main uptrend line since the 2008 lows. So once it breaks that, and as you see, there's just huge negative divergence all the way across here, and it's already red as well. I mean, it's there as well. And this is the monthly chart, and you see the red starting to come in, just as it did right back here before that breakdown, right? And it's right on. See how it broke down to the red, and here we are. It's going to break down this red, and that would, wipe out this uptrend line as it wiped out the uptrend line in 2008. Maybe consolidate for a bit before the final drop down, right? So just want to throw that stuff out there and show you how I can invest in such a way that money is spread out in various assets that offer long-term potential, and not just maybe a day or two swing trade or a quick day trade, but rather the long-term outlook on stocks. And not only have I went through just the stuff that I've shown you, I went back and looked at this stuff ever since the 1930s. You can do that. You can just go here. Well, with any ticker, I didn't even need to change it, but I can go here and I can go back over here. I mean, right here, we're back in we're in 1955, and as you see, here's a trend line in 1970. I mean, I went through and looked at almost all of this stuff, and these indicators are spot on, and you can come to these same conclusions all throughout time. This isn't just something that just started coming up. See, I mean, I've tracked it all the way through the 80s. I've done a ton of stuff here, and so, but the thing is that what I've done is that I've understood the long-term patterns, the long-term trades, and when to get in and when to get out. And now, I mean, and look at these negative divergence. Now is the time to not be in, and there will be a time again to get back in which you can make way more money than 10% a year. You can make, say if you just invested in the index itself, you're up 275% in that same time. But with XPX, so with the SPY, you can trade. Sorry, SPXL. Yeah, this is the leverage ETF. So the leverage ETF, if you traded it, I can't see it. The leverage ETF, you would be up 4,175% since 2009. And it certainly seems to be boom up here in that break moment. So we're going to at least get here, but I suggest that, or I expect significantly more downside to come, and that is not just from looking at a couple of these charts and making some inferences, but rather from looking at this thing from a very long-term time perspective. And whenever it's time to actually get back in the market, when it's time to buy, or whenever it's time to go short the entire market, once it's finally, like, we know for sure it's broken down, like you could tell right here in 2000, 2000, once you finally got this boom, it kind of got back up, questionable here, and then that was official, everybody knew. And then when you start slide over with it, what's it doing? It got rejected by this uptrend. Remember, this uptrend line was supporter that rejected. Boom, more downside, and more downside really fast. That's so, like, right here, and I would say this is kind of in the position we are right now. It fell through, and we hadn't went back up and over, but it's a possibility. But we haven't officially went into a downtrend yet, right? And so this is how you define it. Like, once you actually know for sure, it broke these previous lows. It's obviously in a downtrend at this point. Comes up, it's rejected here. It's time to get short. and you get short, cover your profits here, goes back up, get short again, and you go with the trend. Make your money back down, and then then in the longer term, once you realize this trend has changed back to bullish, how do you know when that happens? Look at this. Just go like right across there, and you see this red line. Boom. For the first time we get back above it since 2000 and really, yeah, since the year 2000. First time you get back above it, uptrend line, time to get in. That's time to get in the market, right? Except you'd get in the leveraged ETF. So, instead of the couple hundred or couple 100% that you make in the actual index, you'd make much more in the leveraged ETF. But yeah, so there it was, breakdown. There it was, breakdown, and here we are, way up here in a very scary place, right here on the back side of this trend line, with more downside to come. So number one, I think just like back there, at this point there's still that possibility that maybe somehow the market's pulled in it, or maybe they just want to, basically the market is about those people who run the market making money, right? And so they might want to make some money. Maybe they go and push it back up over here, and people think, oh yeah, time to go long, and then it goes back down like it did back in 2000, right? Or maybe once it breaks, through here, we know for sure this is a downtrend. And so once you know for sure that's the time to get in the market for the short side, right? And you make your 27 times 3, make your 75% or whatever in a couple months, and then from there, you wait until the trend is changed, such as right over here. You wait for the trend, and you can see this on a weekly chart how extreme the sell-off really is. I mean, it's whenever the market sells off, like so it broke this indicator, right? And you get over here and it did consolidate, but once it finally did break down, look at this. I mean, this is fast. This is super fast. I mean, this is a weekly time frame. That is like crazy, crazy, crazy. But so I guess the whole point was you get here and crossed over, got over that. Look, okay, so this I showed you in 2001. Now here's in 2008. It got rejected on the back side of this red uptrend line, right? Boom, going down. Oh, rejected, but look, caught support and up and over. Time to get in the market. Time to get in the market all the way back up, except with your leverage ETF, and you make a couple 1,000% ever since 2009. So, but yeah, that's all I have, and so I'm just trying to show you, I guess, more of the longer term outlook, and how I can certainly give you much better returns in a way that's not risky, that you will never have to worry about losing any money, that and this, I think this also shows, I think this is important, that these brokers aren't out in your best interest. Basically, the reason why you don't make these couple of 1,000% increases in your account over the course of that many years is because in order for the financial system to work, they can't just be making money for everyone, or then all the money's taken out of the market, right? It just can't work that way. So instead, they need all these different retirement funds, all that type of stuff to fund their current practices, and it's not for your benefit. It is for theirs. It is for the continuation of the market itself. But so basically, investing with me in a longer term perspective, waiting for these trend lines to play out. Like, so, these things, they take time. This is so maybe I don't even get in the trade with the money for 8 months or so. You never know. But once it is time to get in the trade, right? You can certainly get in it. And you can make a lot of money really quickly. And one last example. One last example is here. This is crude oil. This is crude oil futures, and nearly perfect. If you look up here, you see how the price is going higher. And what was this doing? The PPO was going low, or this is negative divergence. The entire time it was going higher. And up here we saw if you go over here to this, yeah. So we're on a 4-hour, 180-day chart right now. What do you see here? So you go here to there, right? You see this? Those two. Now, if you look straight down below it, what was this? This right here was higher than this, while the price is going higher, which means negative divergence. This was the time to get short, right up here at the peak. Oh yeah, everyone's so scared. Everyone thinks it's going to go to the sky. Everybody was talking about $100 oil, and this is on 10/8. This is October. Everybody was talking about oil is going to go to $100. Nobody knows. The only way you can know it's going to happen is by looking at the technical analysis. And what you see from that is that negative divergence, and it was time to get in. And if you look at it right here, this is 30% fall over the past, how many days is that? Over the past 30 days. How much should I say? Yeah, 30% fall over the past 30 days. So, and if you trade the leverage ETF, which is DRIP, and see it had been this long downtrend line, and then finally it broke above, and you make your 90%, 30 times 3 is 90, and 30% crude oil went down 30%, and there's your 30% right there. I mean 90% right there that you'd make once you saw that happen. And so yeah, and the interesting thing is that so these divergences work in both directions. So you remember how earlier it was that if it went from higher to lower, okay, and so here's a perfect example of it. If it went from higher to lower while the price is going higher, that's time to get out of the trade, right? Look what happened here. Boom, sell off right afterward. I mean, in some ways too perfect, but you can also do the same things in a bullish direction. So here, what do you see? I'm sorry, from here to here, what do you see? The price is going down, while this right here is going up. This is bullish divergence. This was the time everybody was saying, oh no, oil is going to go to $100. This was the time to buy. Boom, right there. You made your money. And you can see that. I mean, and that's how I do most of my trading now, as well as I look at a lot of these divergences. What was the example from recently? I'm in a trade on Shopify right now, and truthfully, where is it at? So you have more of like longer term divergences, like from here to there, uptrend runs, because this is the high, and this is lower than that. But what do you see between here to there? Bearish divergence, and that was the time to get short. And it went down quite a bit since then, down 34%. And I currently have a short position on Shopify, and I do think in the coming months that it will break down all the way. This is another stock that once it started going up, it ran up ever since 2016. So this is since 2016, it ran up 500%. But now, what has it done? If you zoom in here at this long-term uptrend line, this is the first uptrend line that I've defined right here, this blue line. It broke down, and also this, so that coincides, and you can see here, I mean, I have this chart kind of marked all up, but as you can see, this is divergence all the way down. But whenever you act on divergence is once it finally breaks a trend, and it broke the trend here. It went up and back tested perfectly, got short here, made money to that uptrend line. However, you can do this on a more longer term time frame and stay short, because yeah, it's gonna maybe bounce back for a couple days, but there's still more downside to come. See, I have this yellow line here. I'm expecting, I think I'm going to cover my position once he gets here, which is another 34%. But I mean, how I'm doing it now is that I only have like maybe like $5,000 or so in any given position. I'm just divvying out my money across things and really trading based off a bunch of technical indicators. And as you see here, see how this red line was going up all this time? What's happening here? It's a topping pattern. Just like the market's a topping pattern. It's starting to get flat. It got down below it. Lower prices to come. And there's a chance that I might cover some of my position right here. I could see this coming down, hitting right in this area on this yellow down trend line and at this Fibonacci level, and then bouncing up some. All right. bounces up some, and then you get back in short again, and it's going to start, see how I have this like these two yellow lines, it's going to start trying to follow probably through here all the way down this 97.4. So you can play this entire trend, down and up, down and up. And another significant short, I guess, I'm going to do this, is Boeing, and this is another stock that, in 2008, once you got this sign that it had reversed, you'd be up 1,000% just on the stock. But what do we see now? Number one, huge divergences right here. Number two, it's right up here. This is a topping pattern. It's topping with these divergences, with this red starting to signify a downtrend or a trend change reversal. And look at this. Look how perfectly this blue line goes. Goes to this uptrend line, perfectly hitting on all these places, right? Perfectly. And look here, perfectly. And look, fell below, back tested. This time it didn't even get back up to it. But so it's back testing on that line that was support. Now it's resistance and lower prices to come in Boeing. Sorry. So yeah, this was, so I actually got in the stock. When did I get in? Oh, I shorted here. So it fell through, it came down, bounced here. Whenever it got back up this trend line, I shorted here, and I shorted from 360 down to 329. Yeah, so it ended up going all the way to, right on 328. Yeah, I almost got the full move, which was 8% of this move, right? And I need to, see, I already got multiple alerts here. I'm ready for it. As soon as it breaks through here, and also here, I'll be going back short on Boeing. And lower price to come here is the first, but I'm expecting probably something similar to the same thing with Shopify. It's going to create like a trading channel, right? A lot of these stocks, I believe, are going to start creating this like so they've already topped, and now it's creating this channel going down in this way, and so the market will stay up here in this channel, eventually dropping out. And I went back and looked at stocks ever since 30s and 40s, and that's what they've always done. They get up here and start topping, they get in a little trading pattern, and then boom, eventually they'll break, and that'll be the sell-off. But yeah, so that's all. This is super long, so hopefully you listen to all of it. So yeah, all right, out.